If you are an investor in Sembcorp Industries, or even if you are just scanning the Straits Times index for a safe place to park your capital, you probably saw the headline and thought nothing of it. Sembcorp is widely regarded as a boring, stable utility proxy. You hold it for stability, not excitement. You hold it because you want to sleep well at night, not because you expect a massive rally. But recently, a specific number has started circulating in the institutional space that completely shatters that boring narrative. We aren't talking about a small dividend hike or a minor operational efficiency. We are talking about a potential $5.5 billion liquidity event. That is a number that the average retail investor hasn't fully priced in yet. And it fundamentally changes the thesis from a slow-moving utility play to a massive value unlock opportunity. If you look at the current share price, hovering around $6.13, and compare it to the valuation targets being whispered by major banks like UBS, we are looking at a disconnect that implies a 25% upside. The market sees a utility company. The smart money sees a renewable energy developer about to cash out. But if you strip away the one-offs and the noise, the real decline, or rather the real opportunity, is far more complex than just a simple buy rating. The headline suggests a guaranteed rally, but the reality is that this value unlock is contingent on a very specific high-risk execution strategy in India. The 25% gap isn't free money. It is what we call an uncertainty discount. Investors are currently applying a massive discount to Sembcorp's assets because the market simply doesn't believe they can pull off this divestment at the price they claim. So, while the upside is real, the risk profile is significantly higher than your typical blue chip dividend payer. This isn't just about selling electricity in Jurong anymore. It is about whether Sembcorp can successfully transform itself into an asset manager without getting burned by the regulatory and operational complexities of the Indian market. I'm Iggy, your Singapore-based market analyst, and my job is to cut through the noise, ignore the sensationalist headlines, and show you what really matters for your CPF, SRS, and SGX portfolios. We don't just look at the stock price, we look at the engine under the hood to see if the machine is actually working. And we've been putting in the work. Since October 2025, this channel has produced over 1,200 videos with more than 600,000 watch hours. We were also honored to be ranked 8th in Tiger Broker's 2024 Influential Tigers. My focus is always on regional and global trends to give you that broader context, so you can uncover hidden gems and potential pitfalls that the mainstream news might miss. Today, we are going to do exactly that with a deep dive, point-by-point analysis through the recent UBS report on Sembcorp Industries, examining the hidden $5.5 billion figure and determining if this really is the key to a 25% rally for your portfolio. First, let's look at the valuation gap. This is the starting point of our investigation. Recently, UBS released a report that turned a lot of heads in the institutional space. They slapped a $7.65 valuation on Sembcorp Industries. Now, let's pause and define what that means. A price target is not a guarantee. It is a calculation based on the sum of the parts. With the stock trading near the $6.13 mark, this implies a potential upside of roughly 25%. In the context of the SGX, where a 5% move is often considered volatile, a 25% gap is an ocean of opportunity. But where is this value coming from? It isn't coming from their traditional business. It isn't coming from selling more conventional power. It is coming from a strategy known as capital recycling, specifically targeting their renewable energy assets in India. The market is currently pricing Sembcorp as a traditional utility, which usually commands a lower valuation multiple. UBS, however, is pricing it as a renewable energy developer that is about to cash out. That 25% gap is essentially the market saying, we don't believe you can do it, and UBS saying, we think they can. Next, we need to analyze the mechanism of this value unlock. The capital recycling strategy. This is a term you will hear often with modern Singaporean conglomerates, similar to what Keppel has been doing. Sembcorp has been aggressively pivoting from brown to green. This means selling off dirty, carbon-intensive assets and using that money to build renewable energy capacity. A significant portion of this green capacity is located in India, a market that is absolutely hungry for power. The core thesis here is simple. Sembcorp builds the asset, takes on the construction risk, stabilizes the cash flow, and then sells it. If Sembcorp spins off, sells, or lists its India renewable energy portfolio, it validates the asset's true market value. Think of it like a property developer. If you build a condo, it's worth a certain amount on your books. But the moment you sell the units, you realize the cash and the market sees the actual profit. Sembcorp is trying to do this with wind and solar farms. They build them, stabilize them, sell them at a premium to pension funds or insurers who just want the steady yield and then use that cash to build more assets. They are currently eyeing Australia and Thailand for this next phase. This effectively turns Sembcorp from a utility provider into an asset manager. Now let's look at the numbers, specifically the hidden 5.5 billion. This is the slide that matters most. UBS estimates the gross proceeds from this India monetization to be between 3.5 billion and 5.5 billion Singapore dollars. We need to put that number into perspective. Sembcorp's total market cap is roughly 10 to 11 billion dollars. If the upper end of that estimate, the 5.5 billion, is realized, Sembcorp would effectively be raising half its market cap in cash. That is absolutely transformative. If we look at the conservative unlock scenario of 3.5 billion, you are looking at a strong cash infusion that can be used for debt reduction. But if we look at the aggressive unlock of 5.5 billion, you are looking at a potential special dividend or a massive war chest for mergers and acquisitions. This is the gold mine that the current share price is ignoring. The trigger event we are watching for is a full or partial divestment, selling stakes in the India RE portfolio to recognize that profit. However, before you go out and allocate your entire CPF ordinary account into this trade, we need to apply the investing Iguana filter. We need to look at the risks because the $7.65 target relies on what we call blue sky assumptions. These are assumptions that work perfectly in a spreadsheet but may not hold up in the real world. The first major risk is the EBITDA margin assumption. UBS assumes these renewable projects will run at a 90% EBITDA margin. Let's define that. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. A 90% margin implies that for every dollar of revenue, 90 cents is profit before those other costs. That is incredibly high, even for solar where the sun is ostensibly free. In reality, you have maintenance, you have transmission charges, and you have operational overhead. Dust settles on solar panels, reducing efficiency. Wind turbines need servicing. These costs usually drag margins down closer to 75 or 80%. If the margin isn't 90%, that valuation target drops significantly. The second key risk is execution risk. We have to be realistic about geography. These assets are largely under construction or in development phases in India. India is a high growth market, but it is also a complex regulatory environment. Delays in grid connectivity are common. Land acquisition issues can stall projects for years. If a project is delayed, your internal rate of return, or IRR, gets killed. The UBS model assumes a fast stabilization, but the reality check is that construction delays are almost a certainty in large-scale infrastructure projects. We cannot just assume smooth sailing. The third risk factor is interest rates. The model assumes a debt cost of 7.5%. Now, for us as Singapore investors, that might sound high, but in the context of developing markets, it's actually quite aggressive. If global rates stay higher for longer, or if the Reserve Bank of India keeps rates elevated to combat inflation, refinancing these projects becomes expensive. Higher interest expenses eat directly into the profit margin. If the cost of debt rises to 8 or 9%, the profitability of these renewable assets shrinks, and the price buyers are willing to pay for them goes down. So how do we synthesize this? What is Iggy's perspective on this trade? While I believe the UBS assumption of a 90% margin is overly optimistic and perhaps a bit dreamy, the direction of the trade is correct. Even if Sembcorp only unlocks 3.5 billion, the bearish estimate, that is still roughly 30% of their market cap in fresh liquidity. That is a massive safety net. I view Sembcorp as an asymmetric bet. The downside is cushioned by its traditional utility business, while the upside provides a free option on this Indian growth story. It offers a rare, safe growth blend for Singaporean investors. Most SGX stocks fall into two camps. They are either growth stocks, which are volatile and risky, or they are yield stocks, which are stagnant and barely beat inflation. Sembcorp is unique because it is a defensive utility with a genuine growth engine attached. Now, let's move to Iggy's assessment and the final verdict. We need to break this down into what is working, what isn't, and what you should do. What is working for Sembcorp is the strategic clarity. The management knows they need to pivot. The balance sheet is relatively robust, and the capital recycling strategy is the correct playbook for a modern infrastructure company. They are successfully moving away from the dirty energy label, which attracts institutional capital that has ESG mandates. The potential cash injection from India is a legitimate catalyst that could re-rate the stock significantly. What is not working, or rather, what is the key risk, is the reliance on perfect execution in a difficult market. The North American occupancy issues we see in other REITs are not the problem here. The problem here is the operational drag in India and the potential for margin compression. If the green transition hits a speed bump, or if the buyers for these assets dry up due to high global interest rates, Sembcorp could be left holding assets that are worth less than the market thinks. Furthermore, the 90% EBITDA margin projection is a red flag for me. It suggests the valuation target of $7.65 is priced for perfection. Regarding valuation, the stock is trading at roughly 1.1 to 1.2 times book value, which is reasonable for a utility but cheap for a renewable growth play. The yield is decent, but not spectacular compared to some pure play REITs. However, you aren't buying this for the 3-4% yield alone. You are buying it for the capital appreciation potential. So here is the final recommendation. For existing unit holders, hold. The yield is decent and you have a free lottery ticket on the India divestment. If the news breaks that they have sold the India portfolio, you will see a sharp spike in the share price. Do not sell into the quiet period. Wait for the news. The decarbonization of Asia is a secular trend that will last decades, and you are well positioned. For new buyers, wait. The risk-reward at the current price of $6.20 is okay, but not amazing given the execution risks. I would not chase the price here. I am setting buy orders closer to support levels, checking against the 200-day moving average. I wait for a pullback to get a better entry price. You want to capture the boring utility value while getting the India growth option for free or at least at a discount. Look for dips to accumulate rather than jumping in with a lump sum right now. This is a prime candidate for the supplementary retirement scheme, SRS. If you have SRS funds sitting in cash, earning 0.05%, this is exactly the kind of trade to look at. You are locking away capital for 10 plus years. I am less concerned with the quarterly fluctuations and more interested in their ability to execute the pivot to Australia and Thailand using the India proceeds over the next decade. If you found this valuable and want to go deeper into the specific entry prices and technical charts we are watching, consider becoming a free or paid subscriber to the Substack newsletter. We dive much deeper into the numbers there than we can in a short video. You'll be in good company. The Investing Iguana has now hit over 1.3 million reads with 65,000 likes across our platforms. We're also thrilled to welcome our growing community of over 30 YouTube Premium subscribers and 19 paid Substack members who make this in-depth independent research possible. Your support allows us to keep digging through the financial reports so you don't have to. Thanks for watching, and I'll see you in the next analysis.